International, and I just wanted to sort of tell you a little bit about what we do here. BOMI International is an independent institute for facilities management education. We specialize in everything that has to do with facilities, all the way from a maintenance technician all the way to property administrators and obviously the financial aspect of managing a building. We have several different ways of going about attending classes. We have online, we have in person, and we have self-study. So you can, get a book at home and do it that way. We can come out and give you the class, or you can attend one of our online classes, which we use this platform right here to make it, which is a lot of fun. As you can see here, there's a lot more information. This PowerPoint will be made available afterwards if you want. At the end of this presentation from Richard, we're also going to give you a discount code for all BOMI, anything you guys would like to buy from BOMI, whether it be online, in person, or self-study. So stay tuned till the end. Obviously, you're going to want to stay tuned for Richard because the presentation is way over my head, but he definitely knows what he's talking about. So I'm going to let him take over now. Thank you very much.
Thanks, Tim. I can see everybody online. Welcome to our presentation here. I've customized this from our Real Estate Investment and Finance course, and I'm just going to concentrate on fine-tuning the connection between appraisals, capitalization, rates, value, and risk. If you have any questions, throw it up in the chat room over there. I will open the conversation at 2 times, about a third of the way through, and at the end for a discussion on risk. Key content, I'm going to talk about the common valuation approaches, market comparison, cost, and income capitalization. And in terms of income capitalization, I'm going to talk about all 6 of those, income, residual, built-up, market, blended, and WACC, and then talk about market impact and rationale for capitalization rates, because there is some confusion on that, I find. So briefly going over the 5 steps of the appraisal process. I'm assuming you are all familiar with this. First step in the appraisal process is to define the problem, whatever property rights are to be valued, whether or not surface rights or subsurface rights, or especially air rights these days, like in New York City, or water rights are included. What's the appraisal going to be used for, such as is it for a purchase, a sale, or a bank loan, and other limiting conditions such as environmental aspects are all in the first step. Second step is the preliminary analysis and data collection in terms of the general data. That's the social, economic, and governmental that drive the overall population area where it's being appraised, and then for specifics, that's relative to the property being appraised. Relative to highest and best use, this is something I stress quite thoroughly in the REIT course, but basically highest and best use is an appraiser must analyze the value of the land, both as vacant as improved. If the appraiser assesses the property being underutilized, they can change it to as if it's utilized and appraise it at a higher price. But that's a very strong consideration. But in terms of the 4 approaches, there's the market, there's the cost, and there's the income capitalization. We will not have time to talk about reconciliation here. In terms of step 4, that slide didn't upload appropriately. I apologize for that. In terms of the market comparison approach, which you're familiar with, it's relative to, hello? In terms of market comparison, you have to select comparable sales. That gets to be very interesting in the commercial property side, because what is your comparable area? If you're in New York, can you compare it to LA? We will talk about that further on in terms of the tiers that they generally break locations into. And then also you adjust for market comparison, the time of the sale, financing, location, and so forth. There's lots of adjustment factors. And you're all familiar with the market approach if you bought a home. There's also the cost approach when an appraiser goes through and evaluates. And there they determine the cost of the construction and the land. And it's often used for insurance purposes and special use properties such as churches and so forth. Can be used by investors to gauge the benefit of purchasing a property, but it does have limitations that replacement cost is not always supported by market value. We have an interesting situation going right now in quite a few areas of the country. Multifamily is generally selling for more than the cost approach is, so by about 15 to 20%. And last but not least, and this is the one I'm going to stress here in this particular talk, is the income capitalization. And what income capitalization does is converts your net operating income. Net operating income is your income before debt service, so it's as if you paid cash, for a property into a value. So the value equals the net operating income divided by a cap rate. And capitalization is a conversion of income into value. Cap rate can be calculated if income and sales prices are known. So this is the calculation of cap rate and then applying it to your property. And cap rates generally reflect the economic conditions, stability, or risk of the property, where it's located, and the cash flow. So looking at income capitalization a little bit more, cap rate definition. The capitalization rate is the minimum rate of return. Somebody has their phone not muted. The capitalization rate is defined as the minimum rate of return necessary to induce an arm's length purchaser to make an investment. By knowing the cap rate, one can determine the value of a property, this V, by using the equation. Because I is known, you divide by a cap rate that you've come up with. So my first polling question of 5 is, what is your level of familiarity with cap rates? Are you very familiar, somewhat familiar, slightly familiar, or not familiar at all? So go ahead and fill in the blank. So it looks like you're very familiar to, somewhat to very familiar. Okay, excellent. Excellent, excellent. So, moving on. What the cap rate is, though, and I'd like to go through this because even if you're familiar with cap rate, I'd like to make sure we have an understanding. Cap rate is really an annuity capitalization. It's a method of converting future, and that's key, future net operating income into a present value. It relies on predictable income streams, typically through leases and discounting. An annuity is a stable and fixed amount of future income provided by a contract and paid periodically. It's a series of dependable payments. Now, don't get put off by all the numbers on here. I'm going to walk us through because it's very important in my mind to understand this. A cap rate can be calculated using discount cash flow. What we had was a V equals IR. So normally you have a net operating income. In this case, I'm using an example of $1 million. Cap rate is 6%. You divide that cap rate, 0.06 in a million, and you would get $16.666 million. What a cap rate really represents, although it looks quite straightforward, is it's a discount rate. You take all these net operating incomes going in the future, and I use 200 years here for an example, and you use that rate, that cap rate, as a discount factor. So in the first year, you can see $1 million discounted at 6% is really, in today's dollars, $943,396. And if you apply that all the way out to 200 and sum it back up, there's your $16,666,522 that matches the value you got before. But this is from a discounting standpoint. But cap rate is really that one that's calculated when you take net operating income, divide by value to get a cap rate. What that cap rate is it really a lot of weighting of a lot of changing factors, because reality in your building that you have for buildings is these net operating incomes are changing and fluctuating all over the map. And your discount rates going forward are changing all over the map, okay, throughout time. How do I get back to my normal slide? Are changing throughout time. So a cap rate is just not a number that's fixed, but a range of numbers, because you have a lot of fluctuation going on. And that range becomes wider the further you go out in time. As cap rates go down, the out years have greater effect. For this example, with a cap rate of 6, if I just look at the first 10 years, only 44% of the value that you're paying for that building is represented in the first 10 years of net operating income. A full 56% is out in the future. As cap rate drops, that shifts further and further out in the future. For example, if you had a cap rate of 4, the first 10 years would only represent 34%. This dropped to 34 if a cap rate was 4. So it shifts out your return as cap rates go down. It's very important to understand that. You want to open the lines for a second for discussion? Does anybody have any questions? Tim, can you open the line?
Yeah, 1 second here. Okay, everybody who is able to speak should be ready to go.
Okay. Anybody have any questions on this slide? No questions? Okay. Because this is going to be a key concept later on. So let's close the line. We'll move on then. So that is cap rate. Now, there are 6 approaches to cap rate development that I've seen used. One is the income capitalization, which we just talked about. This is straightforward. V equals I over R. There's a residual technique, which is a blend of this one, which we'll talk about. There's the build-up rate, the alternative market rates, a blended rate, and a weighted average cost of capital. Next polling question. Which approaches to cap rate development do you use most frequently? Or have you used? See, one person has used income cap, one have used the blended rate, 3 have used the income cap. That's the normal one used. 4 have used, 5 have used. Okay, so most of you have used the income capitalization, the simple V equals I over R, and 1 has used the blended. So let's go on and talk about these other cap rates, though, especially the residual rate, for those of you that are familiar with the income cap. So moving on, okay, so you have all great. The residual rate evaluates the income stream produced by the land and improvements on it separately. Okay? The building residual technique, income from the land is deducted in the land residual technique. The income from improvements is deducted. So let's look at an example here. Under the residual technique, to calculate the residual cap rate, add the weighted cap rates of each part. So in this case, if land is 25% of your value, and you want a cap rate of 12%, which exists in the marketplace, and the building represents 75%, cap rate for that particular style of building is 9. You can come up with a weighted average and say the residual cap rate overall is 9.75%. Now, what's very interesting in the residual technique is the vehicles IR, the income approach, usually is only applicable if you have an office building that is only an office building. But if you have something that's multi-use, for example, you buy a multi-use property that has a hotel, a parking structure, office space and retail, you can actually come up and find the cap rates under the normal vehicles IR and come up with a weighting just like this. So in this case, you would have office space, parking structure, and so forth at the percentages and come up with a residual cap rate and apply it appropriately to the building that you are building or the complex that you are buying. So that is a time when the residual technique can be used. Third approach is a build-up rate. In this case, you can actually come up with a combination of factors. Each individual investor would generate their own, looking at what they consider a fair rate of return, in terms of inflation rate, perceived risk, and profit. So that is, you can build up your own rate. And you do it like here. There's your fair rate of return, your inflation rate, perceived risk, and profit. So you could come up with your own customized rate. You would just generate it. Doesn't have to tie to anything in reality, but it would be for that given investor. A fourth approach to cap rates is you could use an alternative market rate. Many investments could be alternatives to real estate. For example, the stock market could be an alternative rate that you'd use. Right now for Standard & Poor's 500, it's about a price-earnings ratio of trailing earnings of around 20. That equates to a cap rate of 5%. If you listen to Sam Zell, the famous billionaire investor out of Chicago, he uses alternative market rates and compares his real estate portfolios to stock portfolios. But that's a fourth of the cap rates. Now, all four of these have dealt with only the asset side. It hasn't dealt with the investment side. There are two other cap rates that are calculated from the investment side. A blend rate is the first that comes from the investment side. Okay? So here you'd say, okay, real estate investment uses leverage or a significant opportunity cost. A cap rate can be derived from a blending of the loan cost and the yields expected by the investor or investors. Here the flexibility exists with a blended rate. Financing for more than one loan with limited partners participation can have a blended rate. For example, one of the slides did not load. One of the slides we had did not load. Is there any way of bringing it up real quick?
Let me see what we can do on our end. Just give us 1 second here.
Actually, two of them did not load. Tim, is it going to take very long?
Give us just one more second here. He's gonna try and get it to show on the screen. He's gonna share his screen, then you can talk from that.
Okay, it's the blended, yeah, it's the two blended slides. Did not load.
He's got them. He's just gonna try and get them on the screen somehow.
Okay, so here's an example. Okay, this is the second of two, but we'll use this one. Okay. In terms of the blended rate, what this allows you to do, and remember, you're coming at it not from the looking at the asset itself, but from the investment side. A blended rate says, okay, let's say you have a general partner, wants to put in 5% of the money, and they want a 15% return. A limited partner is putting in 10%, and they want a 10% return because they're only putting in the money. They have a lower risk profile. You have a loan one, 60% is being financed out of loan one, and that is a 9.5%, and loan two is a 25% of a total. This adds to 100 at 13.5, and you can see you take a weighted average and come up with a blended capitalization rate. In this case, 10.825. That would be what you'd use as a cap rate. It's what you would return and also what you paid for back for the different investments. Okay? Now, polling question 3. Is what equity percentages do you typically see on a purchase? So we're under polling question 3. 20 to 30, that's one person. 20 to 30. Wow, less than 20 on a commercial, that's amazing. $20 to $30, okay. Yeah, I would have expected about that 20 to greater than 50. Okay, that somebody's risk averse. Usually right now it's about 20 to 30. Now, now the blended, let me make sure we're at the point we're here. Now the blended did not take taxes into account. Taxes are a very important aspect. The sixth method of calculating a cap rate and the second method of those six, which looks at the investment side or the financing side, is called the weighted average cost of capital. I've seen this a couple times in more sophisticated analysis. And here you take into account, it's just like the blended rate, although it takes taxes into account and the flotation cost for getting your loan. So, in terms of the method evaluating cost, implications, borrowing funds. So, let me jump ahead. Cost of equity can be further divided, weighted, and evaluated among different partners, just like we did in the blended, or different loans. And here's an example of weighted average cost of capital. You have the debt, the amount being borrowed. here we'll have 80%, interest rate 4.6, don't you wish, with a marginal rate of 26%. Equity partner 1 is putting in 15%. They're willing to accept a 10% rate of return. Equity 2 is putting in 5%, they want a 15% because they are probably a general partner. You have location costs of $10,000, and this is just a simple example of the total cost being $250,000. What the calculation looks like here is, and here is the loan, the debt piece, 80% at 4.6%, adjusting for the tax rate because it'll be less because of taxes. Here's your equity partner 1, putting in 15%, wants 10% return. Equity partner 2, putting in 5%, wants a 15%, and then you have your flotation costs, but those are deductible. So if you run through all the mathematics, your weighted average cost of capital is 7.93. So that would be another way of coming up with a cap rate. This one in particular is called the weighted average cost of capital, but this is coming from the investment side. Now, what's important, very, very, very important to understand is under the weighted average, or under whatever cap rate you use, you must apply it in the same approach that you used it when it was developed. If you want to use, for example, the blended rate, then you're going to have it as the same split out as you did there. You cannot change partners because if you change percentage mix, it's going to change that rate. I'm going to go ahead take one last polling question here, the fourth one, before we get into the next section. Most of you use 30% equity. This question here is relative to the borrowing on mortgages. What is the average length of time before your typical mortgage loan refinances? Commercial loans refinance. It used to be, before the Big Bang in 2008, they were around 7 years, but now they've changed it. I'm curious what you see or anticipate. Wow, 7 to 10 on a mortgage? That's pretty high these days. 5 to 6 is what I would have expected. Five to 6 is what I've expected. Because generally right now it's around 5. Wow, greater than 10. That's, the bank really wanted your business if they're going to allow you more than 10. So most of you are at the 5, but there are a few more of you that are out 10 years and greater. One is 10 years, one is greater than 10. But most of you are at that 5 to 6. That's typically what I see. Let's talk about the effective cap rate on value. So, in terms of effective cap rate on value, cap rate has an inverse relationship to value. V equals I over R. As the cap rate gets smaller with the same income, your value will go up. It didn't load everything again on this one, but I'm just going to go ahead. So as cap rate, again, as your cap rate goes down with the same income, your value will go up. So for example, if your cap rate is 9%, that will give you a higher valuation than if your cap rate is 13%, for example. Now, here are some typical cap rates the second half of 2015. This is from the CBRE North American Cap Rate Survey, second half. You can go online and get it. It's an excellent source of comparison. CBRE. And end for the second half, 2015. And if you look at the hotels, for example, down here, you can see the hotels from the first half to the second half of the year, the cap rates actually changed. They went up about 12 to 20 basis points. So as cap rates go up, the value goes down in this case. So you can see that they weren't quite as expensive. But I'm going to concentrate up here in the office space, and I'm going to concentrate in the CBD locations. You can see where they broke it out, AA, A, B, and C. And you can see as you go from AA to C, cap rates went from the second half, and this is national average, 5.19 all the way up to 8.50. Now, as you all know, cap rates do vary over time. So here is for, and I'm taking a slice just for offices in CBDs. Here you have Class A, Class B, and Class C, and you can see how it's dropped over time. And for example, if you look at Class A, you can see that Class A was about 8% cap rates in the second half of 2009. They're now down to approximately 5.86. That drop in cap rate for the same dollar means that office buildings, Class A, nationally have went up roughly 37 to 38% increase in value because of that reduction in cap rate. Also, you can see how cap rates, in this case, for Class A, okay, taking this Class A here and breaking it out by tier. Tier is locations around the country. You can see how Tier 1, and we'll see what Tier 1 is in a second, how Tier 1 cap rates are way down below Tier 3. How is that defined? Well, here you go. You can see that Tier 1 would be like a Miami, Florida, or an Orange County. And if you're up here, Tier 3 would be more of Chicago or New York and the Stanford area. And for the same Class A office space, at the same point in time, you can see, depending upon the location, there's going to be a tremendous valuation. If you look at the difference between the cap rate here in Miami, of roughly 5.5 or 5.6, and a cap rate in Stanford, right around a 7, 8 or so, that variance per dollar of net operating income represents a 40% differential. You would pay 40% more per space here in Florida than you would in Stanford. So cap rates vary quite dramatically at the same point in time around the country. Last but not least, risk. Normally people say as cap rates increase, risk goes up. Okay? But if you remember back to the slide, as cap rates go down, what happens to the amount of money that the value represents in the first 10 years of ownership? It actually drops off. Okay? So if you had a cap rate, as cap rates come down to 5% or 4% or 6%, for example, at 6% it only represents about 44% of the value in the first 10 years. My take is, as cap rates drop, your risk actually goes up because what you're doing is you're pushing the value of that building out into the future, what you're going to get for it. Here's my last polling question. cap rates are dropping. If you use risk evaluators and or reduction techniques, which is the most common time frame you evaluate when you're buying a building? How far out do you look at your net operating incomes and your most of you are 5 to 10 years. Okay, most of you are 5 to 10 years. So that's very good because you're outside that period of time when you refinance, because you're forced to refinance after 5 years generally. Okay? So risk is a barrier to successful planning. Therefore, one should minimize risk, obviously. Businesses can avoid risk by not investing, but you don't want to do that because inflation is going to erode your value over time. And there are techniques for reducing risk. I think those techniques should be looked at relative to your risk horizon, okay? A lot of you have triple net leases, and that is you're trying to get and lock down your net operating income, okay, relative to what you're going to get by adjusting for inflation or so forth, okay? There's also the concept of alternet where people are paying the capitalization and so forth. That is a way of reducing risk, okay? There's also, you can get guarantees on net operating income. For example, I've seen a very large insurance company recently are selling off their properties in the sale and leaseback, and they're actually guaranteeing a level of net operating income to the people that are buying it. Another way for adjusting for risk is inflation adjustments on revenue or expenses. You do that on your triple net leases and so forth. Okay? Another way of reducing your risk if you're borrowing money is lengthen your mortgage loan refinancing period. Most of you are at the 5-year. A couple of you, one of you are at 10, one of you are out from 10, but that is pushing out your risk profile. You're adjusting for risk by locking in those returns for a longer period of time. You can actually go way out in time by locking interest rates with bonds versus mortgages. And you could do this if you are a large Corp C or Corp S or a REIT. You'd float bonds and use those bonds rather than taking out a mortgage to pay for your properties. That would guarantee or lock in your interest rate upwards of 30 years or more. I've seen actually interest rate sharing in some leases now, where if your interest rate goes above a certain amount for your financing, I've actually seen that passed through, another way of mitigating risk when you refinance. Obviously, if you increase your equity portion and you're paying 100%, that could fully eliminate your financing risk. And also insurance policy on revenue and expenses. An example there was, I've seen one of my students was looking at buying a piece of property in Phoenix. The property sat on a ground lease owned by an Indian reservation. Indian reservation didn't pay property taxes. What they wanted is insurance. If the Indian reservation sold that property, the ground lease to somebody else, it would be taxed. They tried to take out an insurance premium to protect from that increase if it was sold. And they also tried to reduce the purchase price of the land because it was going to be a pass-through on the ground lease. They could get neither of them, so they passed on the purchase. They didn't want to take the risk of the property being sold. So it's another way they could have mitigated but couldn't. And last but not least, you need to reduce your possibility of leases interaction. And here, I've seen this happen. The go dark clause, where a large tenant can close, like a Macy's, can close but still pay you. And the co-tenancy clause, where smaller tenants are there because the larger tenants have attracted them. I've seen in cases where the large tenant moved out, continued to pay rent because they exercised their go dark clause. The small tenants then moved out and their leases were no longer valid because the main tenant had moved out, so they moved out. So then the property couldn't lease anymore because the main tenant blocked leasing and no one wanted to move in because there's no main tenant. I've seen this happen in a major shopping mall. In 2 years it went bankrupt. And I've seen it happen in a small strip mall because of this. So you want to open up the lines, Tim?
I can definitely do that.
Please. My question is, and I wanted to know if there's any discussion on risk horizon reduction techniques. What other methods are you using to reduce your risk on the properties?
Also, if you are not able to speak, you can also just use the chat box and I'll be monitoring it as well.
I can't possibly have covered all risk reduction techniques that you're using. Well, it doesn't look like anybody wants to discuss any further points. So, Tim, I'm just going to go ahead. Okay?
All right, well, it seems like you did a very good job. Maybe everybody doesn't have any questions because you covered it so well.
Moving ahead, session recap. In today's session, we reviewed the 3 appraisal approaches, market, cost, and income cap. We reviewed the 6 capitalization approaches, income, residual, market, build up, and market. Those are from the asset side, and then the blended and WACC are from the investment side to get that kind of investment. We discussed how capitalization rates affect valuation, and we discussed risk horizon. I'm very glad that most of you are going out 5 to 10 years, but I will caution you, if you're going out 10 years, you're only looking at about 40%, 44% of the valuation. I'm going to suggest that you actually move your risk horizon out further than 10 years to perhaps 20 years because at a 6% cap rate, 80% of the value of that building is, you have to go 30 years out to get it. So, I mean, it's very important to move your risk horizon out as the cap rates come down. And I'm done. It's all yours, Tim.
All right, thank you very much, Richard. I really appreciate it. I'm sure everybody else does. Does anybody have any questions for Richard? If not, then thank you guys, all of you, for attending. We have on the screen ahead CORFAC 10. Wait, we might have some questions coming in, so I'll go ahead and wait. All right, so without further ado, everybody, thanks again to Richard. Thank you all for attending as well. We have the CORFAC 10 preferred partner code for you all. If you ever want to use any of our products online, self-study, or you'd like to order a class from us. And yeah, once again, thank you very much and hope you have a great rest of your day.